Welcome to another lender webinar series with Impact Specialist Finance. My name is Dale Jannels. I'm one of the directors. I'm pleased to have with me today Paul Sawford, who is Business Development Manager for the Tipton. Hi, Paul.
Hi, Dale. Good afternoon to everyone.
Thank you for attending, everybody, today. What I'll do in a second is I'll turn the screen on so Paul can give us a rundown of what the Tipton do. In the meantime, I have some questions for Paul afterwards, but there is a Q&A session or an option at the bottom of your screen there. So if you do have any questions regarding the Tipton Building Society or anything on the market, really, please feel free to send over your questions. In the meantime, what I'll do is I will share the screen. Okay, Paul, over to you.
Thank you very much. Thank you once again for the introduction, Dale, and thank you to all of you that have joined us today. So I'm Paul Sawford, Business Development Manager for the Tipton. I'm based personally over in Surrey. My colleague Phil Lawford and my Head of Sales, Richard Groom, and also Cami Amera, who you may know within the industry. Cami is our Director of Sales and Marketing. So if I can have the next slide, please, Dale. Thank you. So in terms of where we're at, the Tipton are looking at, obviously, as it sounds there, providing mortgage solutions throughout a borrower's life, which can include some of the products that I'm going to talk about during the course of this meeting. We will, as I say, Dale said, we'll have a quick Q&A at the end. Please feel free to send those in. Next slide, please, Dale. Thank you. So I think it's fair to say at the moment that we are receiving a number of inquiries at the Tipton, and I think potentially generally around in terms of the current high loan to values, or shall I say the lack of products that are available in the high LTV arena. We at the Tipton have always had the family assist mortgage, which was the 100% lending, which is perhaps similar, dare I say it, to the Barclays Springboard. And we've also come up with a slightly innovative product in terms of family assist, to have what's called a flex family assist, which is a product that allow your borrowers, your clients, to borrow up to 99% loan to value. So if I just feature on the 100% one first and foremost, basically it's very much subject to income multiples and affordability. So the key to it, whether it's under family assist or the flex family assist, is it must be affordable based upon the affordability calculations, and very importantly, the income multiples, which we apply a sole or joint income multiple of 4.49. So if from, say, a client was borrowing 300,000, they would need income around about 67,000 to meet that part, and then the affordability is assessed. We would then offer your client the option of either a saving, placing some money into a Tipton Building Society account, whereby we take a charge over that until the property is either fully redeemed with us, i.e. the mortgage, or the loan to value drops below 80%. Now, the other option that the family member can produce is a cross collateral charge on a family member's main residence. It can't be an investment property, it has to be their main residence. If the clients were looking to do that, we would need the clients to, the parents, that is, I assume it's going to be the parents for the sake of this example, we would need to conduct a valuation of their property, and we would also need to have them to have independent legal advice, both of which would obviously incur costs accordingly. But it's certainly an option that we can offer. There's the two options. It can either be money into a savings account with a tips or with a charge over, or a cross collateral charge. Now, if we look at the flex family assist, this is where if a client has maybe as little as a 1 to a maximum 10% deposit, we can also look at something similar. So for argument's sake, if they're again buying at 300 and they've got a 10% deposit, we would lend them 270,000 subject to income multiples and affordability. And then we'd need a further 10% by way of either the charge or the savings from the parents, the family member. So in that case, that'd be a £27,000 charge or savings into a Tipton account. So those are the two high loan to value products that we currently offer. Dale, if I may ask to go on to the next slide, please. Thank you. So I guess moving on quite nicely from that is we've had quite a few inquiries recently around our joint borrower sole proprietor or joint borrower sole ownership product scheme. So It's where the family member, as you all know, will not be named on the deeds. There's no requirement for additional security like we do require in the family assist or flex family assists. And clearly, as it states there, it will help your client to boost their affordability calculations by applying the income accordingly. Now, at the moment, the max LTV we have for these type of products is 75%. And actually, if we did have a higher LTV, which we don't, by the way, but if we did, if the clients were lending into retirement, so you may have a slightly older parent, then we would still be restricted, according to the Building Society rules, to 75% max LTV as it would stand. Now, one very slight error I've just noticed on the slide is that we will look up to, on JBSP, up to 4 named borrowers and 4 applicants. And there is a calculation that we apply. So we can look up to 4 borrowers and 4 incomes. Dale, the next slide, please, if I may. So in terms of interest only, again, we're receiving a number of inquiries on our interest only proposition. Relatively straightforward, I may add. We would look up to 75% loan to value that would have a repayment vehicle other than the traditional sale of property. So that could be a second property, maybe an investment in the background. It could be an investment product that would be acceptable to the Tipton or something along those lines. We will then obviously look at the traditional sale of mortgage property up to 60% LTV, but in that case, we do require a minimum £200,000 equity to be in there. One thing I'd probably say about interest only is we will look at part and part, and perhaps not like some other lenders, we don't require any minimum income requirements, which I believe from talking to brokers across the piece, that there's some lenders that do impose certain minimum income requirements, which we don't. Dale, the next slide, if I may, thank you. So in terms of the a little bit generic about the Tipton, who have worked with Impact, by the way, for a number of years. There's a very good business partnership that we've enjoyed. We are a non-credit scoring lender. So again, I worked previously for HBOS LBG back in the day. You know, a very good lender. Obviously have a lot of automated systems. We are, dare I use the term, a bit of old school. So we will do all of our cases are manually assessed with one of our experienced underwriters. What perhaps that gives us the ability to do, however, is to look at a case that may not fit the traditional high street vanilla type case, where there's maybe something a bit quirky, a bit nichey, and very much what I suggest that we sit in, very much specialist in the specialist lending arena. So we can look at some of your clients that have had those occasional blips on their credit files with late payments up to a status 2 within the last 24 months is considered to be within policy. Even a default up to £500, again, must have been satisfied 3 months prior to the dip coming in, again, would be considered to be within lending policy. We would even consider on an exceptional basis defaults over 500, again, must be satisfied 3 months prior. We'll also look at historical payday loans. We'd expect them to have not had one for, within the last 12-month period. In terms of CCJs, we are relatively straightforward. It must be 3 years old and 3 years satisfied, and there's no deviation away from that. So I guess that just gives you a bit of an idea where we look. I wouldn't class us as a, if I may use the term, subprime or adverse lender. I would say it's a lender that sits with people that have had those blips on their credit files, maybe due to something's happened within their lifestyle over the last few years or so. Dale, if I may kindly ask you to pop onto the next slide, thank you. So popping onto the self-employed, again, it's on the slide there. You can see that we traditionally will take the latest 2 years' income figures. We can also potentially, however, look at projections, which must be based on a minimum period of 6 months trading in the current year. And bearing in mind we're now in sort of November 2020, we could potentially look at projection for this year. Very straightforward in terms of how we assess these type of cases. The limited company is underwritten against 100% of their salary and dividend as drawn. And sole traders, it's based on their net profit as backed up by their latest SA 302s and tax year overviews. Now, what I'd probably say a little bit on there is we will look at, on an exceptional basis or case-by-case basis, the most recent year's figures for either of those type of clients, whether it's limited company or sole trader. What I'd probably say to that would be is it must be the 1920s accounts, which I think is fairly obvious at this moment in time. And we would look at something that's got to be trading for probably a minimum period of 3 years. And we will be looking at a business that's perhaps the income has gone up on a very nice upward trend, something along the lines of, say, 20, 40, 60, 30, 50, 60, something along those lines. We could look to use the most recent year's accounts. If the case has gone up by a little bit more, maybe circa 20, 25% more than that, I wouldn't again necessarily say we couldn't not consider it, but we would need underwriters to understand why the business increase has been evidenced. So from a sustainability and plausibility aspect, we'd need some comfort, which could be by way of bank statements, contracts, an accountant's letter, as it's mentioned, error projection, just to understand why the business perhaps is doing so well and the income is going north. So that's what I'd say on the self-employed. Dale, if I may pop on to the next slide, thank you. Now, in terms of the two contractor policies and products that we offer, we've got the long-term subcontractors, the traditional CIS, and then we have fixed term. On the CIS long-term subcontractors, as it states there on the slide, we will use their gross income to assess the level of borrowing. I believe not, there's a few lenders I believe that will do that, but I believe that we're in a number that will look at it, because we pretty much accept that their main source of income is from one provider, one long-term subcontractor. So we can look at this on an employed type basis. We will ask to see the last 6 months CIS slips and base an average of that. We'd also expect the client to be within the industry that they're working within with a 2-year 2-year history. The reference that we request from their long-term subcontractor will just ask confirm, as it says, their gross earnings, and that the relationship will be considered to be ongoing for the foreseeable future. So if they're a sole trader, we would not require their SA 302s tax year overviews. If they're a limited company, we may well ask further questions and inquire a little bit further. In terms of fixed term contractors, our policy there is that they must have 12 months fixed term contractor history. In terms of the current contract, we probably want at this current time a minimum period of 3 months remaining, or at least the comfort that their current contract that may be coming to an end in, say, the next 4 to 6 to 8 weeks is very likely to be renewed with their current employer, open inverted commas, close inverted commas. Dale, if I may pop on to the next slide, thank you. Now, we will look at mortgages for professionals. So you can see the sort of professionals, the range there that we consider to be within the professional range: doctors, surgeons, dentists, barristers, vet surgeons. I think just on this particular slide, what I'd probably say was that we can look to sometimes look at their income, which can be verified by way of the professional partnerships accountant. We won't necessarily always need their sort of latest SA 302s tax year overviews. We could perhaps go for the comfort from the partnerships accountants. A most obvious one would be someone like a dentist that has recently become part of an LLP partnership. Okay, next slide, please, Dale, for me. So lending in retirement, again, we're getting an awful lot of inquiries. So we have no maximum age limit. It's all individual case assessments. Because you're lending in or into retirement, it's 75% max LTV. We will consider income that we class as sustainable, which can be a combination of pension, private, state and company. It could also include net profit from buy to let, because that would be classed as sustainable income. It could also potentially be from an investment type property. We could also consider SIP pots that are currently not being drawn, but have the facility and subject to fund manager confirming, we could look to use a SIP pot that's currently has a nice figure in it, and we can look at that. With standard later life lending, if it's a joint application, you must be able to demonstrate affordability upon the debt. Well, it's a debt stress test. Not a particularly nice thing to say, but we have to make sure that the surviving borrower would have sufficient income. We do have an alternative in our standard later life where if they're able to downsize to a property within circa 5 miles of the subject property, we can potentially consider this as an alternative to the stress test. And as it mentions there, if it was a single applicant, joint occupants, we would require them to undertake the independent legal advice. Dale, the next slide, if I may, thank you. Retirement interest only, again, is within the later life lending arena, the 2 products that we offer. So the max LTV for this RIO is 60%. We will allow people to capital raise 25% for any purpose, which the obvious one at the moment would be potentially parents or grandparents even raising capital to provide to their children or grandchildren to purchase properties. We will consider these type of properties up to £1 million. It's available to borrowers that are 55 and over. Again, the sustainable income comes into effect. We again apply a 4.49 income multiples, and we can consider, like any case, any properties located within England and Wales. We don't, unfortunately, lend in any other place than England and Wales, like obviously Scotland comes up with occasionally. So RIO has no set end date, set term or upper age limit. The next slide, Dale, if I may. So that's the last page, but there was a couple of bits that I just wanted to throw into it. Going back slightly to the RIO, we will also look at these retirement properties, which again, I believe there's very limited availability within the current marketplace. Again, it's up to 60% LTV. There are certain minimum loan sizes and certain income, property restrictions, dare I say it. So we're now surveyors, and we use, by the way, Connells for the majority, if not all, of our valuations. And I might have heard a groan there, by the way. But no, on a serious note, we will look at these specific types of properties, again, based on an affordability basis and from a security property aspect. So I think the last few things I'd just like to mention before we go to the Q&A is income multiples. I've mentioned is traditionally 4.49. We do have a specialist at the moment that Dale may have mentioned in terms of up to 6 times income product, where there's very limited funds, but at the moment we still have some funds available, so we can look at cases over and above 4.49. The current minimum loan size is 150,000. We've recently increased that. There are no geographical restrictions, as I mentioned earlier. And I think the biggest thing for me, and again, we can perhaps pick this up in the Q&A, is I think it's about our ability to work with you, and certainly the ladies and gentlemen at Impact, to talk to you about cases you're looking to place, i.e. these specialist type cases that really do require a manual underwriter to be able to look at the case, treat it on its merits, and to really say yes or no from the very, very outset. Hopefully that's covered the majority of today. Dal, if I may switch back to you and perhaps go to the Q&A.
Brilliant. Thank you, Paul. That's really useful. Just while we're having a look at a few questions, just tell us how has your role changed from pre-March to post-March? Because I think everyone has had a complete lifestyle change. How has it impacted you?
Me personally?
Dealing with brokers and bits.
Well, I think it's fair to say that I think I've only been out once in the last 6 or 7 months. So I'm now currently working from the comfort of my kitchen at the dining room table. My partner is working from home as well, although she's managed to get a bit of a hybrid role where she can go into the office for a couple of days a week. We're both extremely loud, so when we're together, we battle to try and the airwaves. It's always, can you be a bit more quiet? And we try and walk off into the garden when it's nice, or upstairs. So what I try and do with brokers, Dale, is obviously I'm trying to be very proactive in keeping our business partners like your good self up to date with we're up to date with obviously any criteria changes, new products. and obviously keeping people up to date with the service levels, because I think at the moment service is an integral part of the mortgage process, and I'm very conscious and aware of what's required to help you, the brokers, and ultimately the end client to try and purchase their dream house or complete on that remortgage. So my role is very much emails, Zoom calls, webinars like this, and just basically being available for your good selves and brokers alike.
Sure, I appreciate that. And you mentioned service levels. What are you at the moment with the Tipton?
So where we're at the moment is as follows. So if a dip comes in today, we are saying two working days. I didn't mention on the presentation, but it's a soft footprint at dip stage. 48 hours, as long as it's approved, you will get a nice dip approval email with a mortgage certificate. Now, the dip approval email will basically tell you in terms of what's required to progress the case forward to processing underwriting. So once the full mortgage app comes in with supporting documents, we then do an initial assessment within MBU, new business unit, who have assessed the dip. If they're satisfied that they have the mandatory and correctly packaged documents to produce to send it across to processing, at that point we collect the mortgage valuation fee from your client, and then it goes across to processing. And at the moment there is roughly a 10 working day delay from the case being passed across from MBU to processing for them to pick it up at the moment. I wouldn't say it's 5 to 7. I wouldn't even really say it's 7 to 10. I think it's fair to say, being very transparent, it's roughly a 10 working day before that case will be looked at. If you want to go to mortgage valuation early doors before it goes to the processor, we can accept that, but it's very, very much on the basis that if the case doesn't proceed to for any reason, whether that's on behalf of the client or just as importantly from us, it's a non-refundable valuation survey fee that we wouldn't be able to refund.
Sure. And a lot of people, you're not alone in your service levels at the moment. There are some lenders who, we all know, are 20 plus working days behind. What can a broker do? What can we do to make that case flow as quickly as possible through the Tipton model?
I think it's a really very salient point, down a great question. And I think, I slightly alluded to it in the question before, the answer before. It's about cases being correctly packaged. So for argument's sake, it's normally the most recent 3 months bank statements. And I mean bank statements as opposed to transactional lists. I know a lot of people obviously do internet banking, so sometimes it's hard to get hard copy bank statements. But, the most concurrent 3 months bank statements, name and address on, 3 months pay slips if they're self-employed, last 2 years SA302s, tax year overviews. If it's a limited company, we'd also need limited company accounts. If it's deposit, we'd need a gift. If it's gifted, we need proof of the giftee. So we'd need obviously the form. ID is the only element we need certified. So I think, just in summary, a fully packaged and correctly packaged case that allows us to put it in front of an underwriter processor, who will then pick that case up and go, great, I've got everything I need, I will instruct the valuation now. There's roughly, again, a 7 to 10 working day delay from Connells at the moment because they're extremely busy, although I'm pleased to say they are currently still being able to conduct physical valuations even during this current lockdown. So again, it's just helping us to help you.
Yeah, good response. I know you mentioned valuations. Are you finding that we are getting down valuations now, and is it area specific?
Again, good question. I think as a generic, I personally, where I am, I've got to be honest enough to say I can't recall the last down valuation I've seen where a broker has challenged the valuation, a broker or client has challenged a valuation. We are, as I say, quite a traditional purchase type lender. Our remortgage business is very top heavily weighted purchase. So I guess if the estate agent has obviously, put the price in and it's all been agreed, and there's comparable evidence to support the valuation, then most of the time we're getting that. I mean, don't get me wrong, I think my colleagues probably would have found one or two, but I'm not hearing it as a real to the detriment that we're getting a lot of down valuations and, that Connells are down value and everything. I'm not hearing that.
That's good to know. That's good to know. And just really finally, to wrap up, what are your thoughts for 2021, and what are Tipton's projections for business volumes for next year? Not exact numbers, but
yeah, I think it's a good question, and I think it's that, dare I say, it's that, I'm not trying to swerve it, or $64 million question, but I think obviously looking at maybe the end of the scheme, the stamp duty scheme, and I was actually part of the Premier Property Lawyers conveyancing back in 2016 when it was so busy. So I'm sure the conveyancers and solicitors alike will see it, and lenders, to be fair. So I'd just like to hope, and obviously you're going to get the end of the furlough scheme, which obviously has clearly been extended, and obviously the extension of the Help to Buy. So it's going to be a very interesting 4 to 5 months. You've obviously got the traditional Christmas break coming up. But again, if I'm being honest with you, I think there's going to be a lot of people that, dare I say, might be using that time to work throughout. 2021, I think we're going to go into it very much to be, I wouldn't use the term aggressive as such, but we want to lend money. We're a building society. We want to lend money. We will be looking to come out with perhaps some new innovative products to supplement what we've currently got. We've got the funds to lend, and we'll still continue in the current segment areas we've got. And as I say, we might come out with a little bit back into the expat residential world, limited company buy-to-let, which I forgot to mention earlier. We have got some funding on limited company buy-to-let at 70% loan to value. I believe our 3 and 5 year fixed rate on that is sourcing very highly within the marketplace. We'll still look at second stroke holiday homes as well. So I think in terms of me personally getting out, I think, again, I'm not convinced I'll be getting out in the first quarter, Dale. I think it could well be, a second part of the year when hopefully we don't see another lockdown in the early part of the new year. But I'm very optimistic. Perhaps that's the way I am looking at it, through rose-tinted glasses. The glass is certainly half full, and we're here to work with our business partners, like your good self, to make sure that whatever happens in 2021, we're there to support you guys and girls.
Brilliant. That's a really, really good end to finish on. So thank you for that. And thank you for the presentation. Brilliant.
Pleasure.
We have recorded it. So if you did miss anything, please watch out for our emails, and it will be on our website shortly. Thank you again for watching and turning up today. We will do some more of these shortly, mainly on a Wednesday. So again, watch out for the email flyers. But in the meantime, keep well and stay safe. Thank you very much.